Hey, welcome to my live stream. This is Victor with Victor H Investing, and I'm running my live streams. I'm kind of doing a marathon here at the end of the year while I have some time. And I thought I'd introduce the channel a little bit at the beginning of each live stream. I know I've gotten some new faces or some new names, I should say, on the live streams. So basically, I started this channel a couple of years ago, and I'm an active value investor and have become more and more active as I get older, really analyzing companies and making decisions firsthand and buying companies based on what I believe is their intrinsic value. And that comes from free cash flows, principally, and then looking at earnings per share. The other fundamentals I look at is revenue growth. No secret that revenue growth, it really excites investors and makes companies worth a lot more. And I also look at margins. The most desirable companies have high margins. So I like finding companies, if anything, just understanding what the margins are for a company. Some companies have really low margins and just will struggle to be a really, really highly desirable company as opposed to those high growth, high margin companies that we know about. And last, looking at balance sheets. So I like to look at certain fundamentals that I think tell me if a company is a good company, if it's worth investing in. And as I go through live streams, I look at a stock, and that's the criteria that I look at. Looks like we've got a couple viewers. If you have a stock you want to take a look at or a topic, please put it in the chat. I wanted to do a little bit of an opening on this live stream, and then we'll get going. So one thing I wanted to introduce is, in addition to live streams, I host an investor workshop each Saturday, and people that are paid members get to attend, as well as a investor call on Sundays where we talk about, the investing plan for the given week and see where the market's at and analyze companies, determine, which companies look good, which ones look bad, kind of get, general, or I should say differing opinions. And I think it's really productive. In addition to the paid community, you can engage with the community on Discord. You don't have to be a paid member. You could just go on the Discord server. And this information's on the details of the live stream video. Of course, you know where I'm at on YouTube because you're probably watching me on YouTube, but you can also find me on Threads, Facebook. But Discord is pretty active. Good group of investors on there, just, sharing thoughts on particular stocks, events, news, and different channels on that server. For example, growth stocks, technology stocks, as well as other topics that the community's kind of evolved to really like. So I invite you to check out the Discord and just be aware that, of course, Discord has a bunch of scammers on it. So don't be taken by people impersonating me saying that, hey, I'd like to connect with you and I'd like to offer you a really wild investment idea or something. Please be careful on Discord. All right, so let's take a look at the market and see what's going on. So today is the day after Christmas, and between Christmas and New Year's, there's not going to be high volumes of trading. A couple of things are happening. Is it's been a good year. So I would say one general assumption is that investors are happy with results in general. I know I'm happy with results of the appreciation of my stocks, my appreciation of crypto, and they're waiting for 2025 to maybe rebalance or change investments. And the reason that you don't see a lot of selling activity at the end of 2024 is for tax reasons. People will hold off from selling their holdings until 2025 because, frankly, if you sold a stock today, let's say you had a $10,000 gain, the tax on that $10,000 gain is going to be due in a couple of months. Whereas if you just wait 1 week and sell it on January 2nd, you postpone the paying of that tax by over a year. So it's quite smart to just wait a little bit. I've got 2 stocks and I'm going to lighten up on in January. And I think there is going to be some selling in January. I caught a pretty good segment on CNBC, and one of the attendees was Josh Brown. And I do like listening to him. I think he's the real deal. He really knows what he's talking about. And it really talked about the beginning of 2025 may have a pretty strong pullback for the reason I just stated, that there's a reluctance or a delayed selling event that is being postponed until the beginning of 2025. The other is potentially, this one can go one way or the other, but NVIDIA announces, I think, on like February 20th, but leading up to NVIDIA's earnings, the hyperscalers are going to announce. If you see weakness in the whole infrastructure build out for AI in the data center, NVIDIA is going to sell off, and so will Broadcom, and so will those companies that are really expecting to have this, high growth continue on. So that was the second thing he commented on. And third is, we've been in 2 years of appreciating markets. So there's a natural desire to take some of those gains and maybe take some chips off the table. We've done really well 2 consecutive years. We can do a third, not against that. It's just, I'm being realistic that human nature is, hey, let me bank some of these gains, especially as somebody gets older, right? If you think about an investor that's maybe 60 years old, heck, even 70, and they did really well, they've done really well for a number of years, and they're probably going to take some of their stock holdings and put it into bonds or something that's going to be very stable, and so that way they can enjoy their retirement and put money that they need for their living expenses in a lower risk asset class. Now, as we look at sectors for today's action, healthcare was on the positive, and healthcare, boy, it's been a long time since healthcare was number one. They've really had a tough time. In the monthly change, they're down 3.33%, and you can see some of these sectors like technology is up 68%, communication services up 43%. Where's financial services? Financials is number 2. So healthcare hasn't really kept up with the other sectors. It's just really lagged. But it had a good day today. Financials had a good day. And I noticed that Robinhood had a good day, and a couple of others that are in my portfolio. Industrials had a decent day. And these are just slightly green. These are not, the market itself was pretty flat. The S&P was just down a little bit by 0.04%. The Dow, it was up about 0.06%. So the market was very flat. The Russell probably had the most movement. It was up 0.9%. So that was, not a lot of volume, not a lot of movement in the market, but just to point some things out. When we look at the 1 year change, the only sector that was in the red was materials, which means that it was a very good year. You only have one sector down, and this sector here, materials, it just historically is not one of the leaders. The leaders are technology, consumer discretionary, communication services. These sectors really make money for us, and those are sectors that I'm looking to invest. The other observation that I'm making in the market is, historically, you have value stocks and you have growth stocks. Growth stocks tend over time to appreciate much faster because they grow faster, really exciting businesses. But value stocks tend to perform well, not quite as good as growth stocks over a long period of time. But really over the last year, especially, the gap between value stocks and growth stocks really became, larger. And being in value stocks was almost like you were losing a lot of money. You were missing out on gains. I certainly felt that way. I have some value stocks, and I felt like, man, these value stocks are just kind of, putting along at, a low appreciation rate, while growth stocks are just screaming up. So I'm sure that other investors are seeing that. I evaluated my portfolio and looked at my value stocks carefully and have decided I better keep them from now, because for all I know, we have a nice pullback in 2025, and I'll be happy to have those value stocks, because value stocks tend to hold their value better when you have downturns in the stock market. So value stocks are like 3M. It's another value stock that I would put out there. So stocks like Pfizer, Hewlett Packard, Citigroup, those are value stocks. Where growth stocks more like the Metas, Robinhood, Amazon, Airbnb, Coinbase, United Therapeutics, Catalyst Pharma. Those are growing very fast, and those did really, really well, which is great. But I'm not going all in on growth right now. I'm 56, so I don't need to. I think I've amassed enough for my family, and I want to continue to grow it, but I just want to make sure that I've always got enough money coming in where I can take care of my family, retire when I want, and be in a good place. So good balance of growth and value, as well as bonds. All right, so the mega caps. It's interesting. Apple was up a little bit, and Apple's been doing quite well over the last couple months. It's almost up to $4 trillion in market cap. That is incredible. But the others right behind it, Nvidia was down, Microsoft was down, Google Alphabet was down, Amazon was down quite a bit, Meta was down, Tesla was down quite a bit. Broadcom was up substantially. Berkshire was up a little bit. TSM was down. So most of the big caps were down today. And I know it's getting harder to find good value in a market, but there's value out there. We run screens and we find companies that are still, I think, have a very good value proposition for investors. They provide good growth, good cash flows, good balance sheets, good earnings per share. And here's a list of 38 stocks that match good criteria. This is a good beginning to researching companies, to seeing if these companies are worth investing in. So the companies are out there. All right. So if you guys want to talk about a particular stock, pop it in the chat, and I'll take a look at it. So just let me know in the chat. All right. So I've got a couple stocks that I'd like to take a look at. Let me just type this in here. All right. So a couple of stocks that I bought today. Today I bought some Zscaler, and Zscaler is a software company. They're in the security space. I really think it's a good buy for me. And all right. Real Madrid, KK 123. So I'm going to answer your question. Hang in there. That'll be the next one I talk about. So Zscaler is a software company, and what I like about them is they're growing their revenues. That looks good. And I like looking at annual growth rates, and this is the trailing 12 months. Their annual year ends July 31st, but this takes the last 4 quarters. That's what trailing 12 months amounts to. And then I break out the quarterly just to make sure it's consistent and they continue to grow, and it's there. The growth is there. Over time, this percentage goes down a little bit because this number keeps getting bigger. And just the law of big numbers is it gets harder to grow at the same percentage when the number keeps getting bigger. So that looks okay. The growth looks really good for the company. And I really like their gross margins. Gross margins of 78% is excellent. That's a software company for you. So it's growing really well, getting more customers, selling more products, and gross margins are really high. They produce free cash flows, and you can see that they've grown their free cash flows over time. So that's a very good sign. There's a reason why Microsoft is up there at above $3 trillion. Is they're a software company, and they produce a lot of, they have high margins, they produce a lot of cash. Same thing with Apple. So I like that about them, and their balance sheet is good. Their earnings per share is good as well. When I look at their valuation, and I value the company predominantly on free cash flows, I really think Zscaler is a good stock for me to buy. I think it's discounted by 34%, which is a blend. If you look at their cash flows, they're discounted by 65%. And their earnings per share is not as exciting as their cash flows. But cash flows is what Warren Buffett, other investors tend to look at. Predominantly, investors look at free cash flows, a future forecast of free cash flows, and you discount them. In this case here, I'm discounting them by 8%. So I get to 65% on cash and 29% on earnings per share. I take a greater weight of the free cash flow discount method, and I get to 34%. So I'm glad I started a position in Zscaler. I'll probably grow it quickly to about $10,000, and then think about growing it to maybe $25,000, and maybe trying to do that, I would say, by the end of the first quarter of 2025. That'll be my plan with Zscaler. So you asked about Lam Research, and the answer is yes. I bought Lam Research today. Lam Research is in the semiconductor space, and they don't make semiconductors, but they supply the semiconductor industry. So there's companies that supply the equipment to fabricate the semiconductors. So when TSM needs equipment, they're probably buying it from Lam Research, or Samsung also has a foundry. Intel has a foundry. So when they need the equipment, they get it from Lam Research. A couple of things I like about the company is the stock hasn't been screaming up. It actually has been kind of coming down in price. And when I study their financials, you can see that there's red on the screen. For 2024, the revenues were down. But again, taking a closer look at the quarterly, you see that the quarterly, they're actually growing by 20% for 2 consecutive quarters. And they're going to announce on January 22nd, so in 4 weeks or so. And given that they've grown 2 quarters by 20%, I'm expecting they're going to continue to grow at 20%. And once that number begins to be annualized, it's going to be a positive surprise to the market. I'm hoping the stock price rallies, but the fundamentals really support this particular stock price, or I should say, the fundamentals show that this stock is discounted. And let me take you through that. So we're seeing that the company is beginning to grow, which is good. When we look at their gross margins and free cash flow, the gross margin's not quite as good as a software company, but this is semiconductor, so they're lower. 47.6 is very good. And this is consistent with their competitors that are in the space. So margins are good. They're not great, but they're good. And their free cash flow has been growing over time. So free cash flow is growing. The free cash flow supports the overall price of the stock, especially since I'm expecting they're going to start to grow. They've already started to grow for 2 quarters. And when it gets annualized, it'll be a positive surprise to the market. So that's why I started to buy their shares. Balance sheet's good. Analysts believe, just to look at their forecast, 19 analysts cover this stock. And they believe it's also discounted by close to 30%. And their forecast on growth here's revenue growth, is that in the fiscal year that's going to end June 30th of 2025, they're going to grow about 19%. So it's consistent with my expectation, and it's going to continue to grow in the years after. So I think this stock is going to do well for the next couple of years. That's the fundamental analysis that I do before I buy a stock, and I'm comfortable in that position. Again, I like starting, with $1,000 position, and dollar cost averaging up. This stock, I'll get to $10,000 position quickly, and then move to $25,000. Maybe consider going up higher on Lam Research. And when I look at so the valuation of the company, 53%, really nicely discounted as a company, basing it on the growth rates that I expect, and that a bunch of other analysts are also expecting. So really nicely discounted company, good quality company. It looks like, did you see the pending U.S. export restrictions impacting LRCX? I think around 30% of the revenue comes from China. Yeah, that could be a concern. Now, keep in mind that the analyst and in general, those exports restrictions are also, they're already impacting them. The U.S. has export controls on semiconductors. Like NVIDIA is not allowed to sell their premium GPUs to China. That's already in place. Will there be additional ones? Potentially, but I don't believe that Lam has technologies that are like cutting edge. I think their technologies are provided by ASML, which is a Dutch company. So the US has nothing to do there. And Applied Materials also has similar technologies. So I think I need to keep an eye on that just to make sure, the new administration doesn't wreck the semiconductor industry, which I don't think they will. It'd kind of be a bad idea. It would hurt the US quite a bit. But it is something to be aware of. But I think that's taken into account in the growth rates that both analysts and I am expecting. But thanks for bringing that up. It's a good point. So the other stocks, so I bought Lam Research, I bought Zscaler, and the next company that I bought was Chubb. And Chubb, I would say, like all the stocks I'm going to talk about, they ended up coming up on a live stream. One investor said, "Hey, what do you think of this stock? I'm interested in it." And we kicked it around. We've been kicking around Zscaler for, I'm going to say, a month or so. And we actually kicked around multiple security software companies. When it comes to Chubb, I've heard of Chubb, obviously, because Warren Buffett invested in it. I'm invested in Allstate. And we were looking at Progressive, Chubb, and Unum, which is UNUM. And all four companies did well, but the one that had the best fundamentals was Chubb. And when I analyzed it, I just thought, man, the fundamentals look best with Chubb. Their PEs were the lowest. I think their earnings per share was probably not as good as the others, but their cash flow is excellent. They have really high free cash flow. So when we look at their revenue growth, very good revenue growth, just been green across the board. So they've been growing their business nicely. Warren Buffett started investing in them in 2024. And that's a pretty good analyst making a decision on the company. But their free cash flow is just best in class, best in the industry, better than Progressive, better than Allstate, better than Unum, every company I compared them to. So I've decided I'm going to start building a position in Chubb and probably going to sell some of my Allstate, if not all of my Allstate, in 2025. So the free cash flow really grew nicely. Margins were very good. Um, so with the insurance business, it's insurance, so it's not going to be like software, but their their margins are good. Everything else was like really, really good for the company. So I'm going with Chubb, and I started buying their shares today. When we look at Chubb and see what other analysts are saying, 19 analysts are out there. They think it's fairly priced because they really depend on that earnings per share, which I understand. Earnings per share is the easiest to value a company based off of, and the earnings per share is going to grow nicely, and their revenue is going to grow, um, and and it provides a certain value at a low PE. Look at this low PE, but cash is king. Cash is what you know most of the hedge fund investors, big investors, long-term investors, successful investors, they do it on discounted free cash flows. So I use that as a majority of the valuation that I have on Chubb. And Chubb is highly discounted. So I'm glad that I bought Chubb. And the fourth company that's a new position, it seems like a good day to just start buying. I was going to wait until the very beginning of 2025, but it seemed like volumes were down, so I just went for it. Mercado Libre. And the story of Mercado Libre is I wanted to buy it like 4 months ago. I did a video on my channel, and it probably was here, and it just kept going up. And I'm like, geez, man, some of that discount that I thought I was going to get has kind of disappeared. But recently it's really come down. And some people are nervous with, Brazil is in a little bit of turmoil. But Mercado Libre does business in Mexico, Brazil, Colombia, Argentina. Its origin was started in Argentina. So I take that into account, have a higher discount rate on Mercado Libre. But I really like that pullback and started to buy into Mercado Libre. Analysts think it's 30% discounted. I feel the same way. It's about 30% discounted. I did my own valuation based on their fundamentals. Things that I really like about Mercado Libre is their growth. Best in class, better than Amazon, better than Baba. And they really have focus on Latin America, so they could probably outmaneuver, outsell, outperform Amazon and Alibaba down in Latin America. They're also doing financial services. So they do e-commerce and they do financial services. Probably, I'm going to say 60% e-commerce, 40% financial services. So there are some additional risk items since in Brazil. So I used a higher discount rate. But look at this cash flow growth. That is awesome. I think what brought that stock price down as well is a strong dollar. The dollar keeps gaining strength against just about every other currency. That's going to make it a little harder for Mercado Libre to keep that growth up, because if they're doing business in Mexico and pesos, and in Brazil, I think it's called the real, and in Argentina, I'm not quite sure what it's called in Argentina, but those conversions are probably going to take a couple percentage points off the revenue growth. So that'll be just a reality, and maybe that's why the stock pulled back. So that's Mercado Libre. Great free cash flow growth, great revenue growth. Margins are really good. 52% for an e-commerce company and a fintech company is excellent. So I really like that. And I think, I agree with the analyst that it's discounted by about 30%. So I'm liking Mercado Libre. Okay, so Axel, good to see you. What do I think about roast? Let's take a look. So Ross Stores. So I don't like retail. I think it's an industry that is tough. I mean, it's just a really, really tough industry. I tip my hat to Ross for this type of performance. They have to contend with, a lot of real estate cost. You have employees you have to pay. You usually have to staff your stores quite a bit. You have a lot of hazards and theft, inventory, you have to carry inventory, you have to import inventory. Just a lot of things going on. And Ross itself, I mean, I think they're a good running retailer. You want to be, I mean, I think the retailers that are in discount retailing do better than, let's say, a Macy's or just a regular retailer, because you know, everybody keeps going online and buying stuff online. They're growing a little bit. They're growing by 8% in the trailing 12 months, but their growth was a little slow in the most recent quarter. So that is a little concerning. Looks like growth is slowing down a bit. Now, if you have recessions, these guys tend to do well because the consumer has less money, so they go to the discount retailers. So these guys are a decent retailer if you want to be invested in a retailer. I don't. I think retailers produce cash. That's good. But if you're looking for a stock to double in value every 5 years, in my opinion, it's hard to find it in retail. Retailers oftentimes will disappoint me, and it's because their businesses are tough. It's just a really tough business. Let's look at their margins. So gross margins, 32%. That's not bad. That's not bad at all. The only retailer that you can call it a retailer is Kroger that I own, and that's a grocery company, and I really buy them because they're a food company, and I've owned it for a while. And these guys are this is a good stock. This is a good company. If you want to be in retail, I can't argue with this investment. The dividend is small, but you know, Axel, I don't know your age. I don't know what your goal is in investing. If you're young and you're like, hey, I want to have $10 million when I'm 60 years old, I would say you got to look for other stocks. You got to look for stocks that go try to find the next NVIDIA, go try to find the next Meta, go try to find the next Robinhood, go try to find the next, you know, Broadcom, go try to find the next Apple. This is not in that category. These guys are just kind of like brick and mortar, old school, and at best, you're just going to do an okay return. Over 5 years, your annual rate of return, if I add the dividend, is going to be about 8%. And that's okay. But from a stock, you're running quite a bit of risk. 8%, you can get about 6% in a corporate bond. So, and you could avoid a lot of risk. So the risk adjusted return on a bond would be better than investing in the stock. But if you're a young person or somebody that really wants to see their portfolio double in value, you need to find growth stocks. And for me, I stay out of retail. It's just too tough of a business. So those are my comments on Ross. Thanks for asking. All right. So I see there's a number of people on, but looks like you guys are just sitting back. If you want to go over a stock, please let me know and I'll go over it. In the meantime, let me just remind you, we've got a good Discord going on. You can join it and interact with people that are regulars on live streams, and also our paid members that attend the weekend sessions. And it's pretty active. I encourage you to join. Just be careful with scammers on there. And secondly, if you want to be a part of the full experience of this community, become a paid member. It takes $10 just to be a part of, be invited to the weekend sessions, and then you can upgrade the perks that you get. And the details are in the video description. So take a look. All right. So we went over the two stocks that you guys want to look at. There was one stock that really stood out. This came up. We did this screen, I think, on Tuesday. And this stock here really went up today. Global Mofi AI Limited. So these guys provide virtual content production, digital marketing, digital assets for the metaverse. And this is a Chinese company. So Chinese companies had a small rally today, but It just seems like when you buy a stock in China, it's discounted. You can have the same fundamentals for a company in the United States, same fundamentals for a company in China, and I don't know, like a 50% discount for the company in China. So I'm not buying Chinese stocks just carte blanche. I own Alibaba. I own a ETF of Chinese stocks. And this one we looked at on Tuesday. It looked interesting, but just kind of careful not to dive too deep into China stocks. This one did do really well today. The growth is really high, revenue is really low. That does worry me. This is a small company all the way over in China, $34 million in trailing 12 months. So that's a tiny company in China. Good gross margins, but they're just so small. What was their market cap? 9 million market cap. Wow. I mean, this thing could explode, but it could also lose like 50% of its value. Investing in China, for the last couple of years has not really worked. We had like a good couple weeks in 2024 with China stocks rallying, but it didn't sustain it. It didn't like just start going up like the rest of US stocks have been doing for like the last 2 years. So I'm being careful not to buy too many Chinese stocks. All right. So that's going on there. SoFi, good for long-term hold. So, SoFi, let's talk about SoFi. And there, there's like so many ways you can invest in stocks. And I qualify myself or classify myself as a look at fundamentals, and I value companies on free cash flows. I value companies based on earnings per share, revenue growth, and in the case of SoFi, I look at book value for banks and companies that resemble banks, and that's what I base it on. Now, there's other types of investing. Other people would probably describe themselves as they really want to buy into a story and really believe in a company for its story. And I can't argue with that. Some people make a lot of money doing that. It's just I'm following the path of like Warren, or I try to follow the path of like a Warren Buffett, Charlie Munger, value investors. And if you look at, most of the really big names in investing, they all use fundamental analysis and they use discounted free cash flows and so forth. So I still look at that fundamentally as what is this company worth? If I look at the numbers, and I still want to do qualitative assessments of the company. Hey, do they have a really good idea? Are they going to grow really fast? And those things do matter as well. I take those into account. Now, when I look at SoFi, a couple of things that I'll point out is they are growing 32%. That's good growth. They are $2.5 billion in revenue, which isn't very big, but they're growing. That's really good. We look at they don't free cash flow just yet. And they just became profitable, which is good. Okay. Now, their book value, you can find it in the balance sheet. And the book value is almost like a way of a financial institution to show how much like equity they're building for the stockholder. And the book value for this company has plateaued. This is I don't know why it's not. See how like the book value in 23, 22, 21, it's plateaued. It hasn't moved up. That's a problem. If you look at like New Holdings is probably a good example here. I like New Holdings more, and one of the reasons is because it's book value. It's a very pretty chart. See how the chart with New Holdings, it continues to grow its book value. So the equity in this bank continues to go up. That's one of the red flags that I have on SoFi is why isn't their book value going up? It should be going up. New holdings is going up. If you look at JP Morgan, when their book value was going up, their stock price rallied. That's the most valuable bank on the stock market. And I was a JP Morgan stockholder. I did well with this stock. And so you see that smoothness to the data and how book value is growing. JP Morgan is like a great example of a very well-run company, and it continues to go up, and their stock price has gone up over time. It's become an expensive investment, but look at that chart. You're doing well with this investment. This is a bank, so it's kind of a boring investment, but I did well with it. They pay a dividend, and that's JP Morgan. And if SoFi, which is really in this space of lending money, having, financial products, I would give them that they're a new generation company that has new ideas in the space. That's great. Grow your book value, because you can have great ideas and lose money, and at the end of the day we lost money. So you got to start making money. They're not a young company anymore. They've been around for a while. 2018, 2019. You got to figure it out faster. I've invested in Robinhood instead of SoFi, and I've looked at SoFi repeatedly, and I'm glad I invested in Robinhood. And the fundamentals that I saw in Robinhood were far better. When you look at their financials, they're also growing at that clip. They're at the same revenue, but their fundamentals were better, and I went with Robinhood. So do I believe SoFi is a good long-term hold for me? The answer is no. I'm actually not a buyer of SoFi stock. I'd rather pass on that stock. I think there's alternatives that could do better for me. I've been in Robinhood. I've been in Coinbase. That did really well. I've been in Citigroup. That's done well. And recently, SoFi's done really well. I think the last 3 months, SoFi's done really, really well. And I'm glad. So from September to this point, look at that rise. That's awesome. But when they first IPO'd, they were supposed to change the world. They still haven't gotten back to their highs. So if you were an investor back here, you're still underwater. And this was a lot of fluff. This was like just a lot of noise, and investors lost a lot of money. If you were in the stock at the peak or anywhere near the peak, you lost a lot of money. And it took a long time to get back, because around this time is when like Meta and all these other stocks are just cranking up, and you did all right. If you bought at the trough here, you did quite well. So it's just not been a stock that I think is one of the best run companies. And they've been around so long as well, because I do read the comments that people make, and they're like, hey, they have this platform. They're going to be really powerful. They're going to really just, they're really just going to dominate. And I'm like, okay, well, they've been around for 1, 2, 3, 4, 5, 6, and almost 7 full years. So show me dominating, growth. 32%. That's not dominating growth. That you're 2.5 billion. You're not dominating. JP Morgan is how much in revenue? These guys are massive. They are net interest margin is 93 billion, and they're growing at 9%. So it's like, you can't say dominate in 32% when you're tiny like that. If you're growing at 100%, then that'd kind of be a attention getter. David, yeah, I mentioned that stock you'd like to take a look at. Thanks for joining. Let me know. Let's see here. Yeah, you're welcome. Outback Aluminum Welding. So we are looking at WKL. WKL. So is this the right? Is a? Yep, I think I was looking at the right one. So okay, so this is a $39 billion company. So Walters Kluwer provides professional information software solution services in the Netherlands and the rest of Europe, United States, Canada, Asia Pacific. Okay. Okay. So what? So they do software solutions and stuff, and they're classified as industrial. I don't agree with that. They should be a technology company. So it looks interesting. They're in a good space. They're 39.42 billion, and that's in US dollars. Okay. PE is 35. No analysts cover it. The revenue growth trailing 12 months is not impressive. Last year was not impressive. They're 5.7 billion in revenue in euros, but euros and dollars are almost 1-to-1. Okay. And earnings per share is there. Very good gross margins. Excellent gross margins. Free cash flow looks good. Somewhat plateaued, but it's good. So what's going on with their growth? So the good news is that in Europe, they report every 6 months versus every quarter, every 3 months. And the last time they reported for a half was at 6%, which is better. That is kind of slow growth. So it's not overly exciting. They're about a 1 billion euro free cash flow company. So I can't get to $39 billion of market cap. I can get to like 20, maybe 30, but I think this stock's a little overpriced based on free cash flows. And their balance sheet, debt's 4 billion, cash is 900 million. So they have about $3.1 billion of net debt. And their debt to EBITDA is about 3, so that's fine. Yeah, this one's priced a little high. The growth is not exciting. I mean, I could see it being fairly priced, but that's about it. 130. Look at this chart. That looks really good. Nice smooth upward. It's up 18%. Dividend is a small dividend. And that looks really good. I wouldn't invest in it because I'm in the US. And I know that Netherlands has a lot of good software companies, and they have a lot of talent that works on, the software industry. But this one here just looks a little. I think I could get a better valuation here in the US for a like company, and I would have to pass on this one. If the growth was higher, then I could value the company higher. But the growth is just, single digit, mid single digit. They kind of had a slow period. And from what I understand, like Germany's in a recession. Germany's right next door. I'm not sure how Europe's economy is doing, but I'd also be cognizant of that, hey, is the economy in Europe going to sustain their professional services business? Is it going to sustain it well for growth? So thanks for asking. Hopefully you found, and I looked at a different one. I don't think I'm going to get a different answer, but just look at the one you want to look at. So you see, I got the same information. Market cap's the same. It's just listed here, but it's over the counter here in the US. Forward P is 30. Stock price, same chart. Financials are the same. So I looked at the same data. It's just, this is listed in the Dutch market. And I looked at the one that's over the counter here in the US, but it's the same data. All right. Thanks for asking, David. Brian Nelson, look at Oscar Health. Yeah. And I agree with you that, when a stock chart looks steady, to me, that has credibility. I would say that when you see a stock move like this means that they've been executing and communicating with investors quite clearly, and investors believe in them. And this is a pretty good sized market cap. So I agree. This to me gives me confidence. But when I look at the fundamentals, I'm like, whoa, I'm just not seeing a ton of value right now. And if we have like a pullback, all stocks are going to get a haircut, it seems. Few exceptions, but most of them will. So maybe this is a good quality company, but if it pulled back and maybe came down 25%, maybe 30, then it'd be a really good opportunity. Kind of like my story around Mercado Libre. It was priced a little too high for me. It kept going up. Then it came back down about 25%. Then I was a buyer. So, when you watch a stock, you don't have to pay anything but your time and your analysis. And you can just wait for that stock to get to the right price, and then you buy it. You make a good investment. All right, let's get back to Oscar. So as I mentioned earlier, healthcare has just been getting shellacked. So operates health insurance in the US. Okay. These guys are doing quite well, considering that like United Healthcare, I mean, that's just been such a sad situation. And like the other big healthcare insurance payers, they've been struggling. So this one's doing quite well. It's 3.5. Revenue is 8.22 billion. These guys focus on individual and small group markets. Very good. I'm glad that they're doing business at that level. Very good. So net income's there. PE is a little high, 115, but forward PE looks good, 30. Analysts think, hey, it's a hold, but it's discounted. Their growth is exciting. This looks really exciting, 51%. Revenue is 8.2 billion. So that looks really good. Let's look at the quarterly. So the quarterly actually shows that the most recent quarter, they had an acceleration of revenue growth. That looks really good. So this is an interesting stock, and I'll tell you why qualitatively, right? There's a lot of bad news with insurance because of the whole assassination of the CEO of United Healthcare. So it's bringing everybody down. But Oscar's doing great. They're growing their business. They're accelerating their growth. So this might be a really neat stock to buy into. Today, healthcare did well. These guys really took off. This is a good stock. Discounted by 51%. Let me look at their free cash flow. So free cash flow. So it's been a little inconsistent, but trailing 12 months is 900 million. Based on their growth rate, I mean, you could value this company at 30 billion, and they're like three. See, they're making their free cash flow is like 30%, 40% of this number. Wait, 3, 5. No, less than 30%, about 25, 30% of the free cash flow number. So the cash flow is really high. When we look at the quarterly, let me look at the cash flow and see how things have been looking there. So you see that a lot of their cash flow was done in the trailing 12 quarters, was done in Q1, Q2, then negative. Okay. So they had a change in operating. Okay. I see potential here. If I would review this stock, and if you're very comfortable with it, this looks like a really good company. They were priced really high, and then they've come down, but more recently they're doing quite well. And we've had this pullback in healthcare. All the bad news is bringing down stock prices, but that just means we get a discount. This company is still providing insurance to their customers, selling additional health insurance. So this is a good one. Yeah, I would I would say do your homework. I see a lot of value there, a lot of potential, great growth, low valuation, 3.5 billion. This thing can double in value very quickly. So far, this has been my favorite stock of the stream. So I'm going to look at it further after the stream. This is a good one. Thanks for bringing it up. Yeah, the watch list, it doesn't cost money to put it there, and you can follow a stock. Try to become an expert in a couple of industries. Like healthcare has been an industry that I've liked, and I've invested in United Healthcare. Didn't made money, sold it. I invested in Elvance and lost money on Elvance recently because just the whole insurance space has just been getting killed, and that was a bad analogy. The healthcare space has really been being brought down. Um, but these guys, the market perception is one thing. These guys are doing something right, doing business with small businesses and individuals. There's probably a lot of good money to be made there. And they're providing a lot of service, right? A lot of people need to get insurance independent of an employer. So, really like what they're doing. There's a lot of potential there. Futura Fairmont. I think it's the first time you've made a comment on the live stream. Welcome. Thanks for joining. So, battery company, EN. ENVX. Oh man, it's taking a little while. Let's make sure I got my internet still going. All right. So ENOVX or VIX corporation designs, develops, manufactures lithium-ion batteries. It serves wearables, Internet of Things. We looked at a company earlier in the early stream this morning that was similar, 2.15 billion. This is it. Yeah, we looked at this company. So this is my problem with this company. The IPO'd back here. They didn't have any revenue. Now all the revenue they have is 20 million. Now it shows as an extreme growth because they went from literally nothing to 20 million. You mean to tell me it took you 1, 2, 3, 4, 5 years to drum up $20 million of revenue? That's pretty terrible. They don't have a lot of cash. I think they're pretty much even if you look at their cash to debt, which means they're out of money. And if you are out of money and you have negative cash, you're in the danger zone. So you have negative cash, you're burning cash. And when you look at your balance sheet and you say, okay, it's like your home budget, right? I got $200 in the bank and I got $197 of credit card debt. I'm going to have to pay off all my debt, and then I got close to nothing. And you're burning through. Let me look at the quarterly. So you're burning through $30 million of operating cash plus another 20 of capex. You're burning through $50 million of cash every quarter and you're out of cash. Not a good situation. I would not touch this. What's it been doing? Market sees it. The latest, I think that the metrics are probably enticing some investors to come in. Have they been shorted? Short selling not available. This might be don't take this the wrong way. This might be a good stock to short because I just see like a bad situation brewing. And again, they do $20 million of revenue. They're burning $50 million in cash every quarter. And for the year, they did 20 million. 20 million divided by 4 is $5 million of revenue, and they're burning $50 million of cash. Not a good situation. And the other thing too is, again, in technology, 3 years is a long time. These guys have been out for 5 years, and all they can do is 20 million. To me, it's like, what? Guys, you guys are too slow. You need to innovate much faster. If you innovate that slow, the competition is going to blow past you. You're just going to waste everybody's money. So, Lardog, Hamilton Insurance. So these guys do underwriting, insurance, reinsurance, Bermuda, and internationally. Okay. Okay, so they do insurance, kind of like Chubb, Allstate, Progressive. Okay. Small cap, 1.9 billion. Revenue is 2.27 billion. They're profitable. Very low PEs. 30%. Good. But okay, they just IPO'd. They IPO'd last year. Okay. So they have about a little over a year of history. So I think they're off to a good start. So they have revenue, really nice revenue growth. Excellent. Operating margins are good. Profit margins are good. Free cash flow is good. $510 million of free cash flow. They do about, more than 25% of cash if you compare it to market cap. That's very good. This is a good stock. Let's look at their balance sheet, make sure they're not sitting on a bunch of debt. So balance sheet, debt, 149. They got a ton of cash, very little debt. So these guys are loaded, man. This is a good company. Hamilton Insurance, HG. So look at HG and Oscar. Both look really good. These guys are not in healthcare. They're doing more. They're competing against Casualty, Allstate, Progressive, Geico. So that's where they're competing. So this looks really good. And that space, by the way, has been doing really well. Allstate, Progressive, they've done really well for the past year. So good space, good company, great growth, small cap, really interesting. Thanks for bringing it up. GSAT. What is GSAT? Global Star provides mobile satellite services in the US, Canada, Europe. Okay. Okay. They do communications. Wow. Look at that volatility up and down. Wow, it recently just jumped up. This is like a low price stock. 4 billion. Okay, revenues 241 million. They're losing money. Strong buy. Okay. So good growth for a while. They had a little downturn and now they're growing again. That looks good. So the growth looks good. They don't cash well, they were cash flowing, but now they're not cash flowing. Very good margins. And this industry tends to carry a lot of debt. Communications. So let's see. Total debt 422. So their net debt's 371. Debt to EBITDA is 5. I like to see that at 3. So this is a risky balance sheet. This is a riskier company. You see volatility in the data, up and down. Yeah, this one doesn't look good to me. I think the balance sheet is too risky. A 5 is too much debt. And interest rates are going to stay higher for longer. So companies are going to have to pay more interest for a longer period of time. They're not cash flowing in the current trailing 12 months. Let me look at the quarterly. So they did cash flow in the last 2 quarters. That's good. But they had negative cash in Q4 and Q1. So that's what's kind of holding back their trailing 12 months. So this negative cash is concerning. They've been around for a while, right? So yeah, they've been around for a while. So, and this is kind of a known kind of business, right? It's not like, hey, we're trying to figure out the business. So cash flow isn't consistent. They should be consistent on cash flow, and they haven't been. So I'm seeing inconsistent cash flow, a really bad balance sheet, and that's a bad combination. If you don't have cash to pay your bills and you pay your debt, and you have a lot of debt, bad things are going to happen, really bad things. So I would stay away from that stock for my portfolio. All right, so I think I'm going to call it after this one here. Thanks everybody for tuning in. Let's take a look at CSL. All right, CSL. Carlisle Companies. It's been a while since I've seen this one. So their revenue's been inconsistent. This is more of like a private equity company. They invest in other companies. Oh, I was thinking of somebody else. I was thinking of the Carlisle Group, sorry. Carlisle Companies Incorporated operates as a manufacturer supplier of building envelope products solutions in the US and around the world. Okay. So they do building materials. Okay. $17 billion market cap, revenue is $5 billion. PEs are really reasonable. Inconsistent. That this industry is like that. You have building booms and then things slow down. You have a little bit of recession, building booms, slow down. Now it looks like things may be growing. Now in construction, it's I don't think I've ever seen a company where the company is like created a lot of wealth. This one has 133 is very good. So this one is the best I've seen. Usually when I see building materials, construction like companies, they just kind of go up and down and it's not a big wealth creator, but this one has been. So it looks good. It's had a pullback recently. Okay. Free cash, 925, about $1 billion of free cash. So this company's worth 15 billion, 20 billion. So it's fairly priced. I think the stocks run up nicely. Congratulations to stockholders. Very good. But I think it's fairly priced. I don't know about their product. If you study their product and you feel like, man, these guys have a new building material that is just the best and nobody can even touch them. Okay, that might be a good reason to buy. I don't know that. And I'm not big into building materials. I don't own any companies in that space. If that's where you believe you're at and you have an information advantage, that might be a good investment. For me, I'm just seeing like a fairly priced company, and it's not a space that I like to invest in. Like I mentioned about retail, I don't like investing in retail, so I probably wouldn't go any further. This one as well. I don't have an information kind of, I don't have expertise. I don't have an information advantage. I'd probably have to learn a lot just to get to know this company. So I'd probably just pass because it's not a space that I really want to be a big investor in. But some things look good. It looks fairly priced, maybe a little bit discounted. So hopefully you found the comments interesting. All right, cool. So everybody, again, consider being a paid investor if you'd like. And it'd be great to have you. It'd be great to talk on weekends. And when you get on live streams, you get a different, more highlighted handle as well. So I could pick you out as a paid community member. And join us on Discord if you'd like. It'd be great to have you there. You could see comments as we are making decisions on stocks, evaluating stocks, having Discord on stocks. So that's it. So everybody have a terrific evening. And I'll be back tomorrow, and we'll do about the same time after hours. And I'm also going to do a morning session, trying to do a couple marathon streams just to hopefully get exposed to some new people out there that haven't seen my channel. And I welcome you to attend regularly and send me messages on Discord or on the YouTube, platform. I respond to both. Thanks again for joining. Everybody have a nice night. We'll see you.